On the first notice day of the March silver delivery cycle, JPMorgan filed notices to take delivery of 12 million ounces of physical silver through the CME Group's Daily Delivery Report, a single-session filing that adds a significant new data point to what documented records describe as a multi-year institutional repositioning in the silver market. The delivery report, which updates every business day through the CME Group's public reporting system, confirmed the filing earlier today. Placed within the broader context of CME delivery data, vault inventory records, and open interest figures accumulated over the past 16 months, today's notice represents the latest entry in a documented pattern that market analysts and researchers have been tracking through publicly available exchange and regulatory filings. To understand the weight of today's filing, certain background figures are necessary. Estimates derived from CME delivery reports, vault custody data, and registered stock filings place JPMorgan's total accumulated physical silver position at approximately 750 million ounces, a figure built primarily between 2012 and 2019, when silver was trading in the range of $14 to $20 per ounce. That figure is an inference drawn from public primary sources, not a confirmed institutional disclosure. JPMorgan has not publicly confirmed that number in any filing, earnings call, or regulatory submission. What is documented, however, is that this is the same institution which in 2020 paid $920 million to settle federal charges related to the manipulation of precious metals futures markets, and the same institution that for years prior held what analysts described as the dominant short position in the silver futures market, a position characterized as the structural ceiling that appeared to limit sustained price breakouts above key levels. The transition from that documented short posture to the delivery activity now visible in CME records represents a reversal in institutional positioning, whose scale the delivery data continues to describe in measurable, time-stamped entries. To fully understand the significance of today's 12 million ounce delivery filing, it is necessary to examine the sequence of events that began approximately 90 days before the March contract delivery window opened. On Thanksgiving night of 2025, a delivery demand was submitted into the CME system for 7,300 silver contracts. That figure represents 36.5 million ounces of physical silver. At the time that demand was entered, the entire CME registered vault held approximately 1.2 million ounces of immediately deliverable registered silver, meaning the system was facing a physical delivery demand roughly 30 times larger than what its registered inventory could satisfy at that moment. In the hours that followed, the CME's primary data center in Aurora, Illinois, experienced a sudden cooling system failure. Trading was halted for 11 hours across the exchange. When the system came back online, the 36.5 million ounce delivery demand had been rolled forward to the March contract, the same delivery window that opened first notice day today, and the same window into which JPMorgan has now filed 12 million ounces of new delivery notices. According to the data reviewed for this report, that deferred November demand did not resolve. It migrated forward to March with its structural pressure intact. The registered vault inventory environment in the intervening weeks continued to decline rather than recover. The margin increases, volatility events, and price movements recorded across November, December, January, and February were described in market analysis as functioning, whether by design or by outcome, to reduce the delivery pressure building ahead of the March window. The data as it stands today indicates those conditions did not eliminate that pressure. The January delivery data adds a further layer to this picture. On January 7th of this year, CME delivery records showed JPMorgan issuing 99% of all delivery notices in the January silver contract, covering 8.1 million ounces across 1,624 contracts in a single session. That volume alone was significant. But what made the January data particularly notable was a concurrent development in open interest figures. Despite physical deliveries being actively settled and contracts being closed during that window, open interest in silver futures increased by 1,431 contracts during the same period. Under standard futures market mechanics, when a contract settles through physical delivery, the open interest associated with that contract closes. The paper claim is extinguished, a physical bar moves into the buyer's custody, and open interest falls. In January, that standard mechanical outcome was not reflected in the data. New paper contracts were being opened at the same rate that JPMorgan was converting existing contracts into physical metal, meaning the paper side of the market was being rebuilt in real time, while the physical side was simultaneously being drained from registered inventory. On January 7th, the CME also raised silver margin requirements to $32,500, a 47% increase executed within a single week. That increase was one of several margin hikes recorded across the 16-month window that Yahoo Finance reported in February as a period during which large institutional players have been standing for delivery and taking physical metal at discounted prices, with the origin of that accumulation phase placed at November of 2024. The mechanics of how margin increases interact with delivery activity within this documented pattern were described as follows in the source material reviewed for this report. Margin requirement increases force participants holding paper long positions with insufficient capital reserves to liquidate those positions involuntarily. That forced liquidation creates concentrated downward pressure in the paper futures price. The downward paper price pressure then allows entities simultaneously standing for physical delivery to continue acquiring physical metal at prices that the margin hikes are helping to suppress. The transfer that results moves paper losses out of leveraged traders' accounts and converts them into physical inventory gains for the institutions standing for delivery. Whether that sequence reflects deliberate coordination or coincidental market mechanics, the source material reviewed for this report acknowledged both interpretations as present in the analysis. That distinction connects directly to the broader structural data surrounding vault inventory levels, the paper-to-physical ratio, and the Shanghai premium, all of which form the next layer of this report. At its documented peak, the notional paper-to-physical ratio in the CME silver futures market reached 356 to 1, 356 paper claims for every single physical ounce that could actually be delivered against those claims. That system sustained itself for decades on the foundational assumption that participants would not exercise delivery rights simultaneously or at any scale that would expose the gap between paper supply and physical supply. According to the source material reviewed for this broadcast, that assumption failed in a measurable and documented way in early 2026. In the first week of January alone, CME registered silver inventory declined by 18 million ounces, while deliveries across that window totaled 33.45 million ounces. The difference between those two figures, approximately 15 million ounces, had to be sourced from either already allocated inventory being reclassified or from eligible stock being converted to registered status to meet delivery obligations. As of the most current data available, total CME silver inventory stands at 98 million ounces, against a delivery architecture that has been consuming registered inventory faster than it has been replenished across multiple consecutive contract months. The Shanghai premium adds an additional dimension to this inventory picture. The price differential between physical silver on the Shanghai exchange versus the CME paper price currently sits at approximately $10 to $12 per ounce. According to the source material, that spread is wide enough to be actively pulling physical silver out of Western market vaults and redirecting it into Eastern delivery channels at a pace that Western vault data is beginning to reflect. Regarding JPMorgan's estimated 40% concentration in CME silver futures contracts, Fortune described that level as historically abnormal. Prior to 2025, no single entity had typically held more than 10 to 15% of any major commodity futures market. That concentration figure, alongside the delivery data, vault drain figures, and open interest anomalies, forms the documented basis from which market researchers have been drawing structural assessments of the current silver market environment. The countercase to the accumulation thesis was also addressed in the source material and warrants equal presentation here. The 750 million ounce figure attributed to JPMorgan's total accumulated physical silver position is an inference, not a confirmed institutional disclosure. Kitco stated directly that verification of institutional positioning claims remains genuinely challenging due to reporting delays and the structural complexity of how large banks manage positions across multiple legal entities, custodians, and jurisdictions. A bank can be managing client custody logistics, hedging dealer inventory, and facilitating large institutional client delivery requests, while simultaneously appearing from external data to be executing a macro-strategic accumulation. The visible data is structurally consistent with both explanations. Furthermore, the regulatory environment in which JPMorgan's physical position exists is one where the rules can and do change without warning. The CME Group, under Rule 802 and Chapter 7 of its rulebook, retains the authority to modify margin requirements at any time without advance notice, when the board determines that market stability requires it. That authority was exercised on January 7th, when margin was raised 47% in a single week. It was effectively exercised when the Thanksgiving delivery was rolled rather than settled. The source material stated clearly that JPMorgan's physical position, whatever its true scale, exists inside a regulatory container that can reshape itself around any accumulation strategy if the exchange determines that systemic stability requires intervention. As of February 28, 2026, the complete data picture drawn from publicly available CME, CFTC, and exchange records presents the following documented figures. Silver opened at $87.90 per ounce on February 27th and closed at $89.37. Gold was trading at $5,298 per ounce, placing the gold-to-silver ratio at 57.6, a ratio that has historically compressed during periods of physical silver demand stress. Total CME silver inventory stands at 98 million ounces. JPMorgan is currently estimated to control approximately 40% of CME silver futures contracts, a concentration level that Fortune described as historically abnormal, given that no single entity had typically held more than 10 to 15% of any major commodity futures market prior to 2025. Each of the data points that form this report's foundation is drawn from primary sources that are publicly accessible and independently verifiable. The CME Daily Delivery Report, the CME Silver Stocks Report, and the CFTC Commitment of Traders Report, published every Friday at 3:30 in the afternoon Eastern Time, are available on public exchange and regulatory websites. The delivery notices filed by JPMorgan today are documented within those records. The vault drain recorded across the first week of January is quantified within those records. The Thanksgiving delivery demand and its subsequent roll to the March contract are documented through exchange records. The 47% margin hike of January 7th is a matter of public record. The Shanghai premium, currently estimated at $10 to $12 per ounce above the CME paper price, is observable in real time through exchange data. What remains unconfirmed, and what this report has treated with the transparency it requires, is the full strategic architecture behind the documented actions. The source material reviewed for this broadcast stated directly that both interpretations of the visible data are structurally consistent with the evidence, and that the March delivery cycle, now open, will begin to generate the additional data points needed to further evaluate which interpretation the evidence ultimately supports. What the documented record does describe, taken as a sequential whole, is this. An institution that spent more than a decade as the dominant short-side participant in the silver futures market has, across a documented 16-month window, consistently appeared as the primary taker of physical delivery through regulated CME mechanisms. It has done so across multiple consecutive contract months. It has done so during periods when registered vault inventory was declining rather than recovering. It has done so while open interest anomalies during the same delivery windows indicated new paper contracts were being opened at the same rate physical metal was being removed. And it has done so against a backdrop of a paper-to-physical ratio that, at its documented peak, reached 356 paper claims for every single physically deliverable ounce in the registered system. Today, on first notice day for the March delivery cycle, the same contract month that absorbed the deferred 36.5 million ounce Thanksgiving demand that the system could not settle from registered inventory 90 days ago, JPMorgan filed notices for 12 million additional ounces of physical silver. That filing is documented. The vault inventory environment it enters is documented. The 16-month delivery pattern that precedes it is documented. And the regulatory framework that retains the authority to modify the conditions surrounding it at any time without advance notice under CME Rule 802, is equally a matter of public record. The March delivery cycle is now open. The data it generates over the coming weeks will be recorded in the same public reports that produced every figure cited in this broadcast. This has been a factual review of documented market data drawn entirely from publicly available primary sources. We will continue to monitor developments in the March silver delivery cycle as updated exchange data becomes available.